Lehman Brothers did not just fail, it detonated. And when it went down, panic spread through Wall Street and across the global economy. This was not a small firm. Lehman collapsed into the biggest bankruptcy in American history, with more than $600 billion tied to the wreckage. It was supposed to be one of the giants. Old, prestigious, connected, too important to die. And then it died anyway. So how does a 158-year-old Wall Street powerhouse collapse hard enough to help tip the world into financial crisis? The answer starts with a dangerous illusion. For years, Lehman looked strong from the outside. Its name carried weight. Its executives projected confidence. Its numbers looked big. Its presence on Wall Street made it feel permanent. But permanence is one of the most dangerous stories a company can tell itself. Because markets do not care how old you are. They care whether your structure still holds when pressure arrives. And by the mid-2000s, Lehman was loading that structure with more pressure than it could survive. The money looked easy. America was deep in the housing boom. Banks were writing mortgages at huge scale. Those mortgages were being bundled into securities and sold all over the world. As long as home prices kept rising, the machine looked brilliant. Everyone got paid. Lenders made money. Banks made money. Investors made money. Executives made money. And firms like Lehman wanted more. So Lehman pushed deeper. It bought more mortgage-linked assets. It borrowed more aggressively. It increased leverage. It tied itself harder to a market that only looked safe if housing kept going up. That is where the danger really starts. Because leverage makes good times look even better. It magnifies gains. It flatters growth. It makes leadership feel smart. But it also makes the system fragile. When the market moves against you, leverage turns from fuel into explosives. And that is exactly what happened. When housing started weakening, the cracks were no longer theoretical. Defaults began to rise. The value of mortgage-backed assets became harder to trust. Buyers started disappearing. And once buyers disappear, price becomes a problem. Because if no one wants the asset, what is it really worth? That question became toxic. Lehman was sitting on huge real estate and mortgage exposure. On paper, those assets still had value. In reality, the market was losing faith fast. And in finance, faith matters more than people think. This is the part many people miss. Lehman did not collapse only because it had bad assets. It collapsed because the market stopped believing Lehman's version of reality. That shift is deadly. Banks do not operate like normal businesses. They run on confidence. Lenders need confidence. Investors need confidence. Counterparties need confidence. The moment confidence starts slipping, the institution can unravel with terrifying speed. That is what happened to Lehman. Its balance sheet looked increasingly dangerous. Its stock fell. Its funding pressure grew. And every day the market became less willing to believe that the firm was stable. At the center of this was Dick Fuld, Lehman's longtime CEO. He had a reputation for toughness. He was seen as aggressive, combative, and fiercely protective of the bank. In good times, that image looked like strength. In a crisis, it looked very different. Because confidence cannot save a company when the math underneath is breaking. And the math was breaking. Lehman needed options. It needed fresh capital. It needed a buyer. It needed time. Instead, it was running out of all three. And here is where the tension gets worse. Earlier in 2008, Bear Stearns had already collapsed and was pushed into a rescue deal. That changed the psychology of the market. People started believing that if another giant bank got into trouble, someone would step in. A buyer. A rescue. The government. Some kind of backstop. That belief was powerful. It calmed fear. It delayed panic. And it may have helped people underestimate how close the system already was to the edge. Because when markets believe rescue is coming, they keep playing longer than they should. Lehman became the test. It looked dangerous enough to save, important enough to save, connected enough to save. But as the crisis deepened, saving Lehman became harder. Weekend negotiations unfolded under enormous pressure. Potential deals were discussed. Officials, banks, and regulators were scrambling. But no solution held. No clean rescue came together. No buyer stepped in on terms that would stabilize the situation. Then the line broke. On September 15, 2008, Lehman Brothers filed for bankruptcy. That moment hit like a shockwave, because now the market had a terrifying answer to its biggest question. Yes, a giant institution could be allowed to collapse. Yes, a major Wall Street name could fail in public. Yes, the system was far more fragile than people wanted to believe. And once that message landed, fear accelerated. Credit markets tightened. Funding pressure spread. Investors rushed toward safety. Institutions that had looked stable suddenly looked exposed. The crisis was no longer contained inside housing. Now it was everywhere. That is why Lehman matters so much. Its collapse was not just a bankruptcy. It was a psychological rupture. It broke trust at the exact moment the financial system needed trust to survive. And once trust broke, the panic moved faster than policymakers could comfortably control. This is also why Lehman remains such an important corporate case study. The collapse reveals a brutal pattern that shows up again and again in business failure. First, success creates confidence. Then, confidence justifies more risk. Then, risk gets normalized because the numbers still look good. Then, warning signs get explained away. Then, the environment changes. And suddenly, the same structure that looked powerful starts collapsing under its own weight. Lehman followed that pattern almost perfectly. It was celebrated during the boom. It looked sophisticated. It looked built for modern finance. But underneath, it had become dangerously dependent on leverage, fragile assets, and continued belief. That combination works right up until it doesn't. And when it breaks fast. There is another hard lesson here. A company can survive bad headlines. It can survive volatility. It can even survive losses. But once it loses the trust of the market that funds it, the clock starts moving very quickly. Lehman could not regain that trust. Its assets were too questionable. Its exposure was too large. Its flexibility was too limited. And by the time the full danger was obvious, there was no easy path back. That is the real horror of collapses like this. They often look survivable right until the final stage. Then suddenly they are not survivable at all. Lehman's fall intensified the 2008 financial crisis and helped turn a severe market event into a global economic disaster. It became a symbol of excess, of leverage, of denial, of a financial system built to run fast in good times but too fragile to absorb the full force of a reversal. And that is the final lesson. Lehman Brothers was not destroyed by one bad trade or one unlucky week. It was destroyed by a model that depended on confidence, borrowed money, and rising asset prices all staying alive at the same time. Once those conditions broke, the institution did too. Lehman looked powerful. Lehman looked permanent. Lehman looked too big to fail. But under pressure, it was weaker than it appeared. And when the illusion finally broke, the collapse was unstoppable.